October 2006, Las Vegas, Nevada. A buyer signs the papers for a house that has risen sharply in value. The mortgage looks affordable on the first page. Across America, similar deals are being made every day. For years, home prices had climbed, and rising prices made almost every mortgage look safer than it really was. Lenders could point to the house itself as collateral because if a borrower stopped paying, the property could supposedly be sold for more than the loan. That assumption was about to break. The housing boom had been building for years. Credit was widely available. Construction was strong, and buyers increasingly believed that waiting meant paying more. Some borrowers had strong incomes and good credit, others did not. Yet mortgages were being offered to households with weaker credit histories, low down payments, limited documentation, and loan terms that depended on refinancing later. The Federal Reserve later noted that lenders had paid less attention to borrowers' ability to repay because rising house values made the loans appear well secured. By the middle of 2006, serious problems were already visible in subprime adjustable-rate mortgages. The basic machine was simple. A mortgage lender gave a household money to buy a house. Instead of keeping that loan for 30 years, the lender could sell it into a larger pool of mortgages. Those mortgages could then be packaged into mortgage-backed securities and sold to investors. The process moved loans away from the original lender and turned monthly mortgage payments into financial assets. It also created a powerful incentive to keep producing new loans. Then the machine became more complicated. Risky mortgage loans could be divided into layers and combined with other mortgage securities inside collateralized debt obligations. Some structures received high credit rating. Investors around the world bought them because they appeared to offer attractive returns with manageable risk. The Financial Crisis Inquiry Commission later described securitization and the shadow banking system as central parts of the chain connecting American mortgages to global finance. For a while, the system seemed to work. A borrower could buy a house. The lender could make the loan. The loan could be sold. Investors could buy the resulting security, and the house could keep rising in value. Each step reinforced the next one. Rising prices encouraged more borrowing supported more purchases, and more purchases helped support higher prices. But the model had a hidden requirement. House prices could not fall very far. When prices were rising, a borrower who struggled with a mortgage payment might refinance. The homeowner could use the new loan to pay off the old one, often because the house had gained enough equity to support another mortgage. A borrower could also sell the property and avoid a large loss. Once prices stopped rising, those escape routes began to disappear. By early 2007, the weakness was spreading through the mortgage market. Subprime borrowers were falling behind on payments. Investors began questioning the value of mortgage-backed securities. In July 2007, Moody's and Standard & Poor's issued wide-scale downgrades of mortgage securities. The problem was no longer just a collection of bad mortgages. It was becoming a question about the value of financial products built on top of them. That distinction mattered. A single mortgage default could hurt one lender. Thousands of defaults could damage a mortgage pool. But uncertainty about the value of thousands of mortgage pools could freeze trading between major financial institutions. Banks and investors did not always know who was exposed, how large the losses might become, or which assets could still be sold. By the summer of 2007, credit markets were tightening. Investors became less willing to take risks. Banks became more cautious about lending to one another. The Federal Reserve later described the turmoil as beginning in the summer of 2007 after a rapid deterioration in subprime mortgages and a sharp reduction in liquidity in structured credit markets. Meanwhile, the housing market was moving in the opposite direction from the assumptions that had supported the boom. Prices were falling. Inventories of unsold homes were rising. Home builders were cutting construction. The Federal Reserve reported that single-family housing starts in the fourth quarter of 2007 were more than 50% below their first quarter 2006 peak. Then came the foreclosure cycle. A borrower could no longer refinance because the house was worth less. The borrower fell behind. The lender began foreclosure proceedings. The property entered a market already filled with unsold homes. A distressed sale could push comparable prices lower. Lower prices could put more homeowners underwater. Those homeowners then had fewer options to refinance or sell. The cycle fed itself. In 2007, lenders initiated roughly 1.5 million foreclosure proceedings, about 53% more than in 2006. More than half of those foreclosure starts were on subprime mortgages. By the end of 2007, more than 1 in 5 outstanding subprime adjustable-rate mortgages were seriously delinquent, meaning the borrower was at least 90 days behind or the property was in foreclosure. The damage was spreading beyond people who had taken risky mortgages. Financial institutions had borrowed heavily and held large positions in mortgage-related securities. Some relied on short-term funding to support long-term assets. That structure could work when markets were open. It became dangerous when investors suddenly wanted cash. In March 2008, Bear Stearns became the first major Wall Street investment bank to approach the center of the storm. The firm faced a collapse in confidence and a rapid loss of funding. JPMorgan Chase agreed to acquire it with government support from the Federal Reserve. The episode showed that the mortgage problem could threaten an institution far beyond the original home loans. Then September arrived. Fannie Mae and Freddie Mac were placed into federal conservatorship. Their combined role in the mortgage market was enormous, and their failure would have threatened housing credit across the country. The move was another sign that the crisis was no longer contained inside a corner of the mortgage industry. On September 15, 2008, Lehman Brothers filed for bankruptcy. The event became a turning point because markets suddenly had to confront the possibility that a major financial institution could disappear. Confidence collapsed further. Short-term funding markets came under severe pressure. Investors rushed towards safer assets. The financial system began behaving less like separate institutions and more like one connected structure under stress. The next day, the government announced an extraordinary rescue of AIG. The insurer had written enormous amounts of credit protection tied to financial assets. When the value of those assets fell and counterparties demanded collateral, AIG faced a liquidity crisis. The Federal Reserve authorized an initial loan of $85 billion in exchange for a controlling equity interest. The housing crash had now become a financial panic. Banks were tightening lending. Businesses were losing access to credit. Consumers were becoming more cautious. Falling home prices were destroying household wealth. Foreclosures were increasing the supply of distressed properties. The same financial system that had helped expand mortgage credit was now pulling credit away. In October 2008, Congress approved the $700 billion Troubled Asset Relief Program known as TARP. The Treasury Department used the program primarily to inject capital into financial institutions rather than simply buying troubled mortgages. The goal was to stabilize a financial system in which fear itself had become a threat. But the housing market continued to weaken.